Have you ever thought, with so many IPOs happening each week, how could you possibly make sure you don't miss out investing in the big one? Or maybe better yet, limit taking a position in the wrong ones? Well, if you're into investing in IPOs or newly available companies in general, you probably are a little bit of a gambler at heart. Today, I'll share my thoughts on what I think of some of the options out there, which might be more or less riskier to invest in, and also give you a couple of options if you want to take a more diversified approach. And then I'll wrap up sharing my own personal investment strategy in general and how IPOs fit into it. Welcome back to Healthy, Wealthy, and Wise, the channel that's been talking a lot about IPOs. Earlier this week, we had our IPO This Week show where we saw it was a lighter week for new companies coming out. So as I was sitting on my deck today, enjoying the nice weather, thinking about what to talk about next, I thought, let's do something different today and maybe talk a little bit more about IPOs as part of an investment approach, and then I could also share with you how IPOs fit into my own personal strategy. As most of you know, IPOs in general can be risky to invest in, but with greater risk comes potentially greater rewards, right? So I was thinking that I can talk with you today about what I consider the different types of options for passive investing in a new company, with passive meaning not getting directly involved in a startup. Who wants to do all that work? So how I look at it is that there are three main options or tiers, with each tier having a different level of risk. But before I get into it, I just want to make sure you all remember that I'm not a financial advisor and I'm not providing any financial advice for you to act on. I'm just sharing my own personal thoughts and opinions. Got it? Got it. So starting off, I would say that investing in a SPAC, or special purpose acquisition company, is probably the most risky to me. With a SPAC, you're basically putting your money towards the founder of the SPAC to make a decision on a company to acquire, and you don't know what that company is. Typically, you know the sector or industry that is being targeted, but that's about it. And that's why they're commonly known as blank check companies. You're basically giving your money to who you believe is an expert and trust that they will make the most out of it for you, which some could argue is less risky because an expert probably knows more than most of us do, which would be a fair argument. But not knowing where my money is going into seems risky to me. Or maybe I just have control issues. I don't know. To me, this is the option that is the closest to true gambling because the only decision you're making is whether or not to hand over your money to someone and hope that someone knows what to do with it. Now, because of that, one of the positive things is it doesn't take much of an investment of your time. Myself, I've never invested in a SPAC and I'm not hating on it, but I just like the ability to analyze a company that I'm going to be investing into for myself versus putting all of my faith into the person who founded the SPAC. That's just me. Having said that, I know this year they've become much more popular, and I've debated with myself if I should cover those on this channel, mostly because I don't know if there would be much information I could give you other than to say it's out there and what it's targeting. So maybe you guys can help me decide by writing in the comments simply either yes if you want information on new SPACs, or no if you don't really care to hear about SPACs. I'm always wanting to hear what you think. For instance, shout out to Steve in the community, whose feedback supported my own thoughts on potentially covering all the IPOs coming out, which, of course, is what we're doing now with our IPO This Week feature. His input definitely helped confirm an idea I was considering. Alright, getting back on track, the next tier is the individual IPO, which I would say is less risky than a SPAC because at least you know the company you're investing in. With this option, you get a chance to learn more about the company by researching its history and its IPO registration statement or filing. Obviously, there is a range of risk within the individual IPO tier, from the more volatile and risky startups and early-stage biotechs versus the more established companies that have been out there for a while, such as Quicken Loans and Albertsons Companies that went public earlier this summer. Investing in individual IPOs at least gives you the option to learn more about the company by looking at its history and what the IPO is trying to do, whether trying to obtain cash for growing the company or just reimbursing its private equity investors. Plus, you can consider its product or service and compare it to what's out on the market. Obviously, this is the tier we've been covering a lot here on the channel, and that's because, while I'm not an advisor or predictor of how a stock will do, I love the research part of it, which is a lot of my background, and I think if you find the right information, you can make a pretty good decision most of the time. Now, the downside with this tier is that it definitely requires the most time of the three tiers because not only are you investing your money, you're also investing your own time into learning more about if the company is a good bet for you. Well, at least hopefully you're doing that. And taking time to watch our videos show you are putting some of that time in. Personally, in this tier, I look for companies that either have a market edge with an innovative product, a history of growth, and a purpose for the IPO that makes sense to me, which usually means they're investing into growing the company more, not just paying off the insiders. That takes us to what I consider the last tier of risk for investing in new companies or IPOs, and that is through an exchange-traded fund of IPOs. So the idea of exchange-traded funds, or ETFs in general, is really an evolution from mutual funds, which allow you to diversify your investment by putting your money in a fund that holds many companies. Mutual funds, or ETFs, typically have indexes they track, such as the S&P 500 or the Russell 2000, but they also can track specific sectors like healthcare or tech. So using an S&P 500 ETF as an example, the fund invests in companies in the index and looks to mirror the performance that you would get if you invested in every company in the index, which you typically wouldn't do because there would be 500 companies that you'd have to put your money into separately and then allocate that based on the market caps. Again, too much work. The big benefit of an ETF is obviously diversification, so that even if a few companies do poorly in the index, the rest of the companies can pull up the overall return, which makes this potentially less risky than SPACs or individual IPOs. Now that's not to say that an individual stock in the index won't way outperform the rest of the index, but that's what you get with diversification. Less volatility and a steadier performance over time. If you like that approach, you might also like investing in IPOs that way as well, as there are some IPO ETFs that you can consider. And as a heads up, I'm not recommending these ETFs, just wanted to let you know they're out there if you want to look more into if the ETF approach is something that fits better with your investment style and risk tolerance. One of the biggest out there in assets managed is the First Trust U.S. Equity Opportunities ETF, ticker FPX. This ETF has been around since 2006 and tracks a cap-weighted index of the 100 largest IPOs over the first 1,000 trading days of each stock, which means it gets sold on that 1,000th day. Year to date, the fund has a return of 4.72%, so hardly explosive, but still higher than the broader S&P 500 market. Another option might be the Renaissance IPO ETF, ticker IPO. Now that's an easy one to remember. This ETF has been around since 2013, and its approach to holding IPOs is different than FPX in that the fund adds sizable new companies quickly, but can add others up to 90 days later. Once they have a company that has been public for 2 years, they are removed at the next quarterly review. The fund also manages fewer assets than FPX, and with its different approach, its current year-to-date return is significantly higher at 30.17%. The reason I picked these two were just to show you that just because they're both IPO ETFs, they are different, and you should look deeper into the approach that each fund takes. There are more than just these two options, but these are two of the more well-known ones. You also can find IPO ETFs that focus on international companies instead of American ones if that's something you're interested in. So in general, with IPO ETFs, you get diversification where you're more likely not to miss out on the big IPO because you're exposed to more companies, which leads to less volatility and risk. Plus another benefit is that it takes much less time than researching into individual companies that are going public, although you still need to look at the fund's approach and history of performance, which, as we just talked about with these two examples, can differ significantly. Anyways, so that's a quick look at what I consider to be a risk-tiered approach into investing in newly public companies. As I've said, I haven't invested in the riskier SPACs, but I also haven't invested in the potentially less volatile IPO ETFs. That's not saying they're not right for you, but that's just not my approach. My approach is probably more conservative than a lot of you in the community. I'm more old school, maybe because I started investing right before the dot-com collapse, and I know that when everything seems good and easy, it's not. Anyways, about 90% of my investments are in mutual funds and ETFs, with most tracking large cap US companies with more exposure on the growth side. I do have an international growth fund as well, just for some more diversification. The other 10% or so of my investments are in individual stocks because, although I feel like most of my money is protected by the other 90% from me making bad decisions, I do like to have a little more input into what I think can get a better return. So yeah, maybe I have a little gambling nature in my blood as well. And I'll invest in IPOs within that 10%, give or take. I do like the idea of the IPO ETF because I like ETFs in general. I just think IPOs are more risk and reward, so I'd rather stick with the traditional index funds for the majority of my money and then try to pick and choose in individual companies as more of a challenge, which is something I enjoy. So I'm probably not that gambler some of you might be on here, and yet some of you might be more conservative investing than me. But that's okay because this channel isn't about me predicting the next huge stock or being a fanboy to a specific company, which probably frustrates a few of you out there. But the channel is really about me using my 20+ years of experiences in investing, as well as in researching something, and then sharing the most pertinent details in a quick and easy to understand approach, with a little analytical reasoning sprinkled in. At least that's what I'm trying to do, and I hope you all are finding value in it. And with that, please like the video if you enjoyed it, and remember to type a yes or a no in the comments if you would like for me to cover SPACs in the future. And if you're new to the channel, we'd love to have you join the community. Just got to press that red subscribe button. And with that, I will wish you a good rest of your week. Thank you for watching, and until next time, have a great day.